The best of Money Matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin, Jeong. The Q2 U.S. earnings season showed solid results, with recession risks remaining contained, supporting expectations for continued earnings growth. However, much of the strength has been concentrated in a narrow set of stocks, masking weaker performance across other sectors. As investors navigate this landscape, key questions remain. Will earnings growth remain broad-based or continue to rely on a few sectors? How resilient are emerging markets in Europe if global growth slows further? And how should portfolios balance the upside from AI and interest rate support against rising market risks? Well, to find out more, joining me now is Jack Su, who's the head of Discretionary Portfolio Management of Asia at Lombard Odier. Jack, welcome to the show.
Good afternoon, Hongbin. Nice meeting you.
Thank you so much for joining us. Well, Jack, Q2 earnings in the U.S. came in solid, with S&P 500 earnings up around 9% and 80% of companies beating estimates. At the same time, recession risks are still seen as contained. How much confidence should, investors take from this earnings resilience? And is the market perhaps too optimistic about growth holding up?
No, I think the market is just slightly overconfident about the earnings estimates. I mean, if quarter two earnings shows that before the actual tariff being implemented, companies been accelerated their spending and also not too concerned of front-running some of the tariff risk, so they've been importing more quickly. In the third quarter, we probably see some setback in the earnings because, once you have front-run your purchases, the second quarter things will be a bit slower. But market have already priced that in the third quarter. So we think the fourth quarter will become to pick up again. And therefore, with the recession risk still being quite low, market is still quite confident about the outlook on the economy and the stock outlook in the future.
Right. I mean, we've seen global consensus earnings estimates for 2025 and 2026 tick higher during this reporting season. Do you think these upgrades are sustainable, though, or could they face downward revisions later this year?
Well, I actually think they are quite sustainable. I mean, obviously, you cannot say this with 100% confidence, given the policy outlook and the geopolitics environment is quite volatile at times. But if we think about the main earnings driver in the United States, which are a lot to do with AI-led related communication services, electricity companies, and data centers, etc., the growth of these sectors are still quite high. The capital expenditure coming out from global investors are increasingly rising. So what we expect to see is this earnings growth is still going to continue. But what are the risks to whether this will not be sustainable? One is currency. A lot of these tech earnings in the second quarter came from some of the dollar weakening trend that we've seen. So the foreign currency earnings that came back to the United States tech companies have been increased from a currency perspective. So if the currency outlook have a substantial rebound in the dollar, which is not what we think is going to happen, then this earnings outlook can be deterred. Or if there's a surprise no rate cut from the Federal Reserve in the coming quarters and rates stay quite elevated, I think that's also a risk to the earnings outlook. But that are both unlikely scenarios in our view.
Well, as you mentioned earlier, I mean, it looks like tech and communication services have done the heavy lifting for earnings, largely driven by AI monetization, cloud, and digital advertising, while more traditional sectors lagged. But with the latest lackluster results from NVIDIA here, it's fueling concerns that a massive run-up in artificial intelligence spending is slowing. So, Jack, what risks do you see in such narrow market leadership? And how should investors position if the AI-driven gains begin to cool?
Well, I think lackluster is a strong word for the earnings result we heard just now, because the current expectation, which is very high, but the trajectory growth in the future is slower than expected. But I think for an investor perspective, right, that is still a super trend for investors to stay invested. But at the same time, given the leadership of AI no longer the only story in town, right, we are anticipating a bit of a growth rebound starting in emerging markets. And that will probably be lasting the next 6 to 9 months, at least starting in the fourth quarter. We are seeing or anticipating that the Europeans, especially Germany, will be announcing a major fiscal stimulus with details to be announced in 2026. So that could be a major catalyst of European equities in the future. And Japan, the structural story is also quite strong. So what I'm saying is, when you have only one leadership where all the money will power to the same place, but when you are given choices of different high-quality investment opportunities, investors are beginning to divest their money, some away from the U.S. assets where most people have exposure to now, and begin to rotate into these emerging market opportunities, which we have done in Lombard.
Okay. Well, meanwhile, financials have also been stronger than expected, helped by capital markets activity. Do you see the strength as cyclical, or could financials remain a structural earnings driver in the next few years?
Do you think there is a structural earnings driver in those key sectors that we discussed earlier? And I also think that the new catalyst that I mentioned coming out could become another set of new structural earning driver. When you have an earnings cycle that's on a positive trend in one country, and then you also have earnings cycle in other countries, that also creates some kind of wealth events and more money being created, wealth asset prices go up, and then you have more fund flows flowing around and lifting prices altogether. And that's a positive effect on what we call money velocity in economic terms. When money is moving fast, then that means that there's a lot of transactions, there's a lot of activities in the economy. That tends to be reduce the risk of recession, and therefore, and you're going to welcome the rate cuts, and economic activity will boost, and earnings will obviously be structurally growing as a result. I mean, that's the base case scenario. If it doesn't happen the way we like it, then obviously we will have to investor will have to adjust with more agility in that scenario. But we're not seeing that sign of recession or negative scenario yet.
Okay. Well, in Europe, earnings were better than anticipated, but still weaker than elsewhere, with the stronger euro and auto sector weighing on results. What's your outlook then for European equities, and do they still look relatively unattractive compared to other regions?
Well, we have a neutral outlook on European equities. That means we expect low single-digit return in the next 6 months or so. And the reason is we had one of the strongest rally in European equity this year, with the stock market, I think, returning in north of 20% when you take into account the currency impacts from the euro versus the dollar, if you're a dollar-based investor, mostly in Asia. And looking ahead, right, the earnings outlook for European equities in the coming month have yet to rebound, because when you have a strong euro, you also have a less earnings opportunity for exporters, such as the auto sector. When you have a strong euro, you also make the domestic product less attractive for, global consumers. And therefore, earnings have been on a downgrade for quite a few months, and valuation in the European equities have become less attractive. But having said that, as I mentioned, 2026, we're anticipating some more major capital expenditure plans of coming out from these governments of major European economies. And when that announcement comes through and valuation normalizes in Europe, which I think is not expensive but not cheap neither right now, then we will see probably an opportunity to regain into an overweight exposure of European equities. But for now, it's too early. We think there's a better time to go on European equities to add exposure later in the year, or maybe early next year.
Okay. What about in terms of emerging markets? I mean, they're expected to slow near term but recover into 2026 with structural drivers such as semiconductor demand, India's domestic consumption, and governance reforms in Korea. How compelling is the EM story right now, and are investors underestimating the long-term opportunities there?
Well, we are quite positive on emerging markets. Overall, we have an overweight exposure in emerging market equities. We have an overweight exposure to emerging market hard currency bonds. And we also think emerging market currency is going to appreciate against a weakening dollar outlook. And what we are seeing there, why are we becoming more positive on the EM space, right? When you have, number one, the U.S. Federal Reserve start cutting rates when most number of central banks have already been through a round of rate cuts. So they are restarting when everyone's ending their rate cuts. That means interest rate in the U.S. will be reducing, and attractiveness of that market will reduce, and money will start reducing exposure to the United States. And when that happens, money will start leaving the U.S. and coming to another market. And emerging markets right now, if I look at the earnings outlook of emerging markets, we are seeing the upgrade of our earnings by 6% year to date. First, the United States only seeing a 5% earning upgrade from what market expected early in the year. So there's a better earnings outlook happening in emerging market this year. Secondly, when you're an investor, especially as a dollar-based investor, when you see currency appreciation, that will be an additional boost to your equity upside potential. And if earnings are going up, your currency is going up, then the equity market outlook become more and more attractive, especially when you have a liquidity-driven market coming from U.S. in the emerging markets. And then when that happens, you have a positive market sentiment, you have a positive currency, then you think about the bond market. You have a reducing interest rate in the United States, and you still seek for higher yield and locking in longer-term deposit alternatives. And you find an attractive yield right now, we think emerging market, which is averaging 6 to 7% yield, with still mostly investment-grade bonds. I think that's an attractive area to enter to lock in some of the yield that we cannot no longer get in the banks. And then if the currency outlook is also positive for bonds, the ability to repay debts when your domestic economy's currency is rising and you borrow in dollar, have improved. So your credit quality have also improved. So in other words, for emerging market, I think many stars are now aligned for investors to return and bring more investment back in the emerging market. And we have already seen that in the fund flow in the last 2 months.
Okay. I mean, tariffs, slowing U.S. growth, and extended investor positioning are key risks, even as indices hit new highs. So how vulnerable do you think markets are to a sharp correction if tariff impacts intensify in the second half of the year?
Well, I think we have got the most intense parts of the tariff discussion in the last 3 months already. Mm-hmm. What we see now is we are coming towards much closer to the conclusion of most of the tariffs. I would say the biggest economies that have a trade deficit or trade surplus with the United States have seen a conclusion of the trade negotiation. I mean, you can have to exclude China here. But China, if you look at the situation, we have seen the tariff rate rising all the way to 145% and now coming back down to somewhere close to the 40. And what we've seen now is, I think just 2 days ago, we heard U.S. President Donald Trump have mentioned, if you do not give me the magnets and rare earth exports, then I will have to raise your tariff. In other words, both sides seem to have cards to play and bargaining chips. And when you have bargaining chips on both sides, you tend to get a successful negotiation. And when you have a balanced negotiation, it's hard to see the tariff rate really shoot up. And so emerging market overall, I think we have now removed a lot of uncertainty about tariff rates now. Most countries have seen what the tariff rates are and they will respond accordingly. And therefore, with that already concluded, the analysts forecasting earnings outlook to be upgraded still. That's a very positive sign for us.
Okay. Well, retail investor positioning has risen as well, and U.S. valuations are fairly full. So is this a sign of froth, or do fundamentals still justify today's valuations?
Well, valuation of the U.S. stock market is at 22 times PE ratio, which is high versus its history. It's what we call as 2 standard deviation events. Only 1 to 2 years in 20 years you see valuation at this level. But then if you look at the fundamentals, the earnings outlook is still being upgraded after the second quarter earnings results. And with this growth momentum likely maintaining into 2026, it's hard to see valuation to be correcting anytime soon. And secondly, if there's no recession that's going to happen and the Federal Reserve is going to reduce rates, that will actually, in fact, improve the profit margin further as the borrowing cost for companies will reduce. So what we are seeing, yes, investor positioning is high, valuation is high, but it's not to a frothy level that we're really concerned about. So when you have valuation and position at this level, you tend to see less upside in the coming 6 months. Mm-hmm. Probably is therefore we put a forecast of 3% upside, but then you get evidence you get 5% total return. But then that's still positive, actually calling for a major setback. But you never say never. There is, in the short term, we already reached this level and we're going to enter the month of September and October. We will not rule out a temporary setback in the stock market. If so, I think that's an opportunity to re-enter or position back in the developed market equities.
Okay. Lombard Odier also mentions taking profits on developed markets in July while still, favoring emerging markets and communication services. So how should investors think about rebalancing their portfolios at this stage? Should they take some chips off the table or lean further into growth sectors?
Well, we are staying invested. To attempt to exit the market on a temporary basis is very dangerous in this environment. If you think about what happened in April, market went down for 2 weeks, no one re-entered the market, and the market rebounded fully in just the next 2 weeks. We are a believer in long-term investment. In short term, yes, the risk of a temporary setback exists, but in the medium term, we're still seeing a positive outlook at positive asset return. Right? So what we are doing is, instead of exiting, we have taken some minor profits in different market equities, and we position those eggs or money into emerging market. We see a better risk-adjusted return opportunity. We are forecasting an upside of 10 to 12% emerging market stocks in the next 12 months. So I think this is more opportunity for us. Okay, if the short-term outlook is more volatile, we can remove some money from that market and put some into emerging market where there's a lot of strong fundamental practice and positioning is still quite low in the current juncture.
Okay. So for a long-term investor, then, what's the right balance between risk management and not missing out on market upside?
Well, the way we approach it, we have to go back to the word strategic allocation. In other words, to stay invested, you need to balance your assets, your equity exposure, with other assets too. For example, you need to consider whether you need some bonds, You needed some gold in case geopolitical event happens again or some surprise inflation happens. And you also have to have more alternative asset classes where the factor that drives the return for your portfolio is quite different to what happens in the stock and the bond market. And with that diversified portfolio of income generation or earnings generation for your portfolio, that way you can navigate this somehow volatile and complex market environment with more ease.
All right. And finally, before we let you go here, Jack, what are the key catalysts investors should watch over the next few months that could shift the equity market narrative?
Well, definitely we are watching closely. The September Federal Reserve outlook. There's a high probability they will do the rate cut. If not, market would be quite disappointed. Everyone's also focusing on the Federal Reserve board members. The change of members will suggest how long-term, how dovish the Federal Reserve can become. That's a key factor. Thirdly, I think the currency outlook right now is quite important. The dollar weakening trend is a key driver to many of the non-U.S. market earnings and also tech earnings. And if it doesn't happen, the dollar continue weakens, and that would change the earnings trajectory and rebalancing probably required. I think those are the three key factors I'll be looking at in the near term.
All right. Some great information there. Thank you so much, Jack, for joining me today.
Thank you so much, Hongbin.
Thank you. That was Jack Su, who is the head of Discretionary Portfolio Management of Asia at Lombard Odier. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the Audio app. That's AWEDIO, Audio at the App Store and Google Play.